Before we get into the whole adjusting entry business there, we have a little bit of terminology to tackle here, and just some comparative analysis of a couple bases of accounting that you could potentially use just to make some points about why we're doing what we're doing in here. So again, the matching principle will become evident what we're talking about here in a moment. So again, instead of cash basis accounting, and we could do that possibly, and again, that's just cash received minus cash paid. Financial accounting instead, what we're doing here is we're doing accrual-based accounting, which is measuring economic impact rather than cash impact. And this language should sound familiar to you because we've discussed it in earlier videos and earlier handouts. Again, benefits we observe because we switch to accrual basis accounting is we can recognize receivables like accounts and notes receivable, and liabilities such as AP, and recognize revenues, of course. Again, what's the standard we've been employing here? Recognizing when they're earned and expenses when incurred. So again, this is nothing new here, just sort of hanging a name on what we've been doing here. Again, measuring these incurred expenses against earned revenues gives rise to the term matching. So that's what you've been doing, or we've been doing, without actually knowing it. And again, this matching process culminates in the form of what? The income statement. I mean, that's the ultimate matching of revenues and expenses right there. It takes place there. Right. So again, it's going to happen automatically as long as you follow the standards of when to recognize revenues and expenses. So that's the beauty of it. As long as you fall back on that position and you understand, I'm not recognizing a revenue until I've earned it, or expense until I've incurred it, matching will happen without you having to even think about it. Now let's just do, again, a little comparative analysis, cash basis versus accrual basis here. So this is going to be in the month of March. Important that you understand the cutoff here, because it's going to help, put together the example there, because that's what we're talking about. We're looking at what we should be doing for for this company in a specific month, in this case for Gallant Corporation. So here's the transactions that relate to revenue in one form or another. So the Gallant received $5,000 from customers billed for services provided in February. That's number one. Secondly, they received $6,500 for customers services provided in March. Third, they billed customers $10,000 for services provided in March. And then fourth, they received $4,000 for services to be rendered in April, so next month. And then lastly, fifth, services provided in March for customers who paid in advance in February with $3,500. So first, we're going to ask, what would cash basis accounting say is your revenue from this? Well, all we care about here is whenever they received cash. So you'll notice received, received, received. Every one of those is a cash receipt, 1, 2, and 4. So if we combine those three elements there, we would get $15,500. That's just lining up those numbers. You already see them right there. So anytime they receive cash, it doesn't matter what the cash was received for. We would just say, well, by this basis, it's earned. Now again, if we look at the contrast here between what we just discussed and what we're going to do for accrual-based accounting. Oop, got to get the underline out there. There we go. You get the idea. Right, so now when we switch to that, now what are we looking for? We're looking for something that says, have we earned this money in question? And of course, the phrase here you'll see repeated that indicates that is what? For services provided in March. It's repeated 3 times in here. Whoops, boy, that got away from me. It's so nice if it just let me draw on the screen, because I have one of those computers you can do that on, but alas, not an option. Services provided in March. There, so it appears 3 times, so we know that 2, 3, and 5 are going to be included in the definition of revenue under accrual basis. So that's where we're going to get our $20,000 from. Those $6,500 for cash received, for services provided, the billed, and then $3,500 that was paid in advance in February, but now we finally make good on that advance payment in the current month, March. So again, we get a different story of what we consider to be our revenue depending upon the basis in question here. Now we're going to look at the other flip side here. So that was the revenue. Now we'll look at the expense side. So let's say in the same month, so you're in March again, they paid $35,500 for supplies, insurance, wages, and equipment. And of that, only $10,000 represents use of goods and services. What's cash basis going to say is their net income or net loss? Well, again, revenue was $15,500 from the previous slide, minus the $35,500 ends up a net loss of $20,000. Now we switch to accrual basis. Accrual basis says, well, we knew that we earned 20 and they incurred what? 10, because again, that 10,000, because they use goods and services, means that's been incurred. So we get $10,000 of net income. So we get a vastly different story here. So the lesson to be learned from this is, why do we choose the accrual basis versus cash basis? Is because it helps eliminate the roller coaster that you will observe if you go with cash, because some businesses, their cash expenditures in 1 month versus another are going to be vastly different. Like you can see for this company, they spend a bunch of money on equipment. They're probably not going to spend money on equipment again the next month in April. So you might see all of a sudden things swing the other way, and then in April we have this giant net income, because again, we're just measuring cash. Now, just a little bit of instillment of reality here. If you were trying to, if you're doing cash basis for a business, you probably wouldn't be able to subtract everything I suggest here, the whole 35.5, because the government's going to look at you and say, well, guess what? We'll accept things like this in cash basis, right? Supplies, insurance, and wages, but not the equipment. In that case, they would make you treat the equipment like you would under accrual basis, but let the other, those other three elements would be okay. So we call this modified accrual. So you probably wouldn't actually be able to subtract the whole 35,500. So in other words, in practice, is there such a thing as pure cash basis? And the answer is no. There'll be some modifications to it. That's just the way it works. So we're going to get to the end of the accounting period. All right, so that was so we're done with that little tidbit there. So now we'll get into the actual adjusting entry portion here. So again, so we get to the end of the accounting period, and we have some matching loose ends. That's how I want you to look at your adjusting entries. These are just matching loose ends. It will take place in the form of adjusting entries, is how we tie them up. Now I want you to think back to the first video, first handout, I believe the second page of the first handout. And I talked about external versus internal transactions, and I promised I would give you a proper term for those. In other words, internal transactions, how can you refer to them by something like a terminology? And the answer is, looking at it right here, meaning that adjusting entries, just clean that up a little bit, is a form of internal transaction. Another form that you'll observe is your closing entries. So we'll talk more about those again in another video. Again, these are mandatory if you want to adhere to the matching principle. If you fail to record your adjusting entries, basically what you're doing is you're failing in the whole matching idea, because that means there are going to be some expenses and revenues that aren't being recognized properly. So again, when you're looking at your income statement, you're not going to be looking at a complete picture of what actually took place. So again, it's not going to be an accurate portrayal of what the business did. So that's why you got to do them. Right, so as for this is just sort of the basics of adjusting entries right here. So again, what are we doing here? We're doing entries to update and report changes in accounts which do not impact management's decisions during the accounting period, but of course we have to do this in order to achieve proper matching. Now, a little bit about what I'm talking about there, like what does that mean? Accounts that, again, they're not impacting management's decisions. Just think of it this way. So you have this prepaid insurance account. I mean, it's just sitting there. Now, we could, in theory, update it every day, but does management care about what today's insurance expense is? And the answer is no. Or what's today's rent expense? Or how much in supplies did we use up? Or what's depreciation expense for today? Everything I just described there is going to be part of your adjustment process, because management effectively looks at those amounts and says, well, who cares? It doesn't impact our decision. And that's because, and this isn't a concept you'll see in the 102 material if you take Accounting 102, and it intersects with the idea of a sunk cost. It's just like it sounds. This is a cost that has already happened. It's in the past for the business, right? The money is spent or will be eventually spent if, in the case you haven't actually paid off a liability, for example. It doesn't matter. It's spoken for. It's done. So it's not going to impact your decision, right? You don't need to know how much insurance expense is today, because what could you possibly do about it one way or the other? And the answer is nothing. So management's just going to let these numbers just sit there stagnant and not care, because it doesn't impact the decisions. But we get to the end of the accounting period, now we got to do the updating. So that's what we mean by adjusting entries and updating everything. All right, so your adjusting entries it's very simple. It's going to affect at least one balance sheet account, which in this case will simplify to asset or liability. We don't care about owner's equity accounts. One income statement account, which simplifies to revenue or expense. So if you take into account the fact we're only going to increase a revenue or expense, we're not going to look at any other facet there. If there's an appendix somewhere in your book about another treatment of adjusting entries that would entail some other fancy footwork, you don't go into that anymore, so don't worry about it. So that's what, because we're only looking at either increasing a revenue or increasing expense, our transaction patterns are limited to just 4. That's all you have to concern yourself with here. So here they are. So right here, what do the first two have in common? Well, we're only going to be crediting some revenue account. And what do the next two have in common? We're debiting an expense account. And of course, the credits to revenue would increase it, and the debits to expenses would increase them. So that's where it falls back on the idea of only increasing those. So what are your two possibilities for the revenues as far as what's the other half of the transaction? The debit half can only be 2 things. Debiting, meaning increasing an asset, or debiting, decreasing a liability. In the case of the expense transactions, you're left with crediting, decreasing an asset, and crediting, increasing a liability. Now, we don't really think of our adjusting entries in terms of expenses and revenues. We have other subcategories for them, which is going to be where this bracketed material here is going to be fleshed out in a moment. So the real way we look at them is in terms of deferrals and accruals. And again, the idea of categorizing adjusting entries by those two categories begins with a question. Now, this idea has evolved over time. So the original question that I remember when I was tutoring this many, many years ago, we would ask this question here: have any assets changed hands before booking the adjustment? Now, I since refined it because I realized something, because it doesn't always entail an asset exchange, right? Sometimes that's not really the guideline here. So it's broader and better to ask this question: is there a prior transaction or transactions driving the adjusting entry? In other words, can you look at something in the accounting records, point to it, it's happened in the past, right? You booked something previous, and now we need to update something. If you answer yes to that, you're dealing with a deferral. Now, generically, we can refer to these as prepaid expenses and unearned revenue. So that's generic terminology. I'm giving you how the handout, and also by virtue of that idea, the video pairing of accounts is going to look like. So in this case, our deferred entries are going to be like so. So we're going to be adjusting supplies for the amount that's been used up, and now it's going to be supplies expense. So yeah, in the earlier examples, when I was giving you that entry for supplies expense, debit, supplies, credit, it was actually an adjusting entry. I just didn't tell you that that's what it was. It was just like, so you'll be like, oh, you've already seen that. So now we get to hear it should seem familiar. It's not so foreign. It's not really that new of a concept. You've already encountered it. And of course, now we're also going to have to adjust prepaid insurance for what? The portion of that that's expired. Why? Due to the passage of time, and has now become insurance expense. The portion of our prepaid rent that has now become rent expense, because same idea, passage of time. And unearned fees, again, that's a liability account, and that have become what? That are now fees earned because why? We've provided the service for the customer. So it's no longer a liability. We need to recognize that it now is revenue. So that's your unearned revenues, the other half there. And we're also going to lump in here adjustments for depreciable fixed assets such as trucks, but you'll notice for these we don't use like just trucks and an expense account. We have 2 totally separate accounts from trucks. We use depreciation expense and a new account we'll talk about in the next video called accumulated depreciation. So you see how that works, but in the next one. All right, so what if you answer no to the question? Then you're talking about an accrual. In other words, no, I can't point to something that's previously been booked and that we're updating. So if you're in that position, now you're dealing with, generically, we call these accrued expenses and accrued revenues. So again, dealing with how the handout's going to address it. So here, we're going to have to adjust for, now you'll notice there's kind of a bit of a sing-song here, like a bit of a rhythm to how it sounds when you talk about accruals, and that is we have to account for utilities expense that's been incurred but not yet paid. So it describes the whole transaction, right? We have to book some sort of expense, and the offset is going to be to a payable. Same thing for the next one. Salaries expense that's been incurred but not yet paid because of timing differences between the end of our accounting period versus when we pay our payroll. So that's a very, very common one that you'll encounter. And you'll see that in the accrual video. Fees earned but not yet received, or possibly even in our billing system, as I suggest, because of, again, a billing lag. So we've actually provided the service, but we have yet to receive it, so we have to book something to some sort of receivable there to make that all balance out. And lastly, interest revenue that's been earned but not yet received. Because why? Because in this case it relates to a note receivable, and the note receivable isn't due yet. But in the meanwhile, time's passing and you're earning the interest revenue, so we need to book that. And then the offset is to, again, another receivable to reflect that reality. Okay, so that concludes sort of the setup here for the accrual, the adjusting entries, not just accruals, all of them, deferrals and accruals. This is the setup one. And then next video, we'll specifically address how the deferral entries look. So I'll see you there.